Howdy, welcome back to Dion Talk. This is going to be a nice short live done on my phone, so I won't be answering questions during the live, but I will answer questions in the comments below. I want to talk about how interest rates can go down 2 weeks in a row when so far this year in 2020 we've seen the Fed raise rates twice and talk about raising rates up to 5 more times this year. If you're new to my channel, the purpose of my content is to help people reach financial freedom. My goal is to teach you that the average person can reach financial independence and make work completely optional in 10 years or less, even if you're not starting from the best position, which is what I did. I invested in buy and hold real estate. A little over 10 years ago, I was not in a great position. Single parent, 3 kids, making about $17 an hour because I'd been laid off from a police department. Started teaching truck driving at a truck driving school. Found out about $89,000 in bad debt in my name that I didn't know existed until the divorce, so that was a lot of fun. But you flash forward till now, about 11 years later, financially independent, 16 rental units, cash flow is a little over $14,000 a month, averaging about $800 to $1,000 pure cash flow per unit. That's after principal, interest, taxes, insurance, and setting aside for repairs, maintenance, and vacancy. My goal on my channel is to help people like you understand how to do something like that. Some people start and grow a business and get to the point where it's big enough for somebody else to run the day-to-day so you don't have to work every day. Some people invest in stocks and use the 4% rule, which in 2020 is starting to turn into the 3% rule. For the people who invest in real estate, interest rates matter. For the last 2 years, we've had record low interest rates where it's not that it was easy to find a deal, but it was easy to increase cash flow on a rental that you already had. I refinanced a couple of my properties and increased cash flow by, $250 a unit? Trying to wait and time it with the sound. I was competing for this live with a couple of dogs this morning, so if dogs just start barking like crazy, I'm just going to try to talk louder than them. The question is, am I going to go down the slides when I'm done? Or fall? Inflation in the last year has really taken off. It's been out of control. So one of the Fed's strongest tools to fight inflation is to raise rates. So they've talked about raising rates. And in the last two rate increases, we've seen 25% the first time, or percent, that would be awesome. A 0.25% and a 0.5% rate increase. So if we've had 2 increases and the Fed is talking about increasing 4 or 5 more times this year, how can we see rates go down like we did for 2 weeks in a row? The first thing to understand is banks lend on margin. In the 80s, when interest rates were 18%, banks weren't making 18% gains. In 2018, when interest rates were 5%, banks weren't making 5% profit. What happens is the Fed sets a rate, the amount that they're going to lend money to banks, or technically how the rate that banks are supposed to lend money back and forth to each other. So, for the last 2 years, the Fed rate's basically been 0. So when your bank gives you a loan at 3%, they have some overhead, they have some expenses, but that margin between 0 and 3 is where they make their money. In the 80s, when the Fed rate was 15 or 16, and the bank's rate was 18 to 20, that's the margin where they make their money. Then we see inflation take off, and the Fed wants to raise the rate from 0. So here's the key thing on why rates went up so fast. Banks lead the Fed. So the Fed says early this year, we're going to raise rates. They just say it. They don't do it. They just say we're going to raise rates. So banks raise the rates, anticipating the increase to keep their margin there. Then we have the first increase, that 0.25, or that quarter point. 25 basis points. And that narrows the margin for banks, so they increase the rates. We travel forward, the Fed keeps saying we're going to raise rates several times this year. They do it again, 50 basis points. Banks raise rates. So the banks led the Fed because the Fed was saying we're going to raise rates. Then the Fed actually raises rates, so banks raise rates. Banks lend on margin, and here's the second part. They compete with each other. Major banks, big institutions, credit unions, companies like Guild Mortgage, Fairway Mortgage, all of the other lenders that are basically using the same interest rates to compete with each other. So the Fed is still talking about increasing rates. They have increased rates twice, but competition starts to set in. So for the last month, we haven't seen a rate increase from the Fed recently. We're expecting one again soon, most of us are, but banks are competing with each other. So since they increased to lead the Fed to keep their margin there, and then increases happened, and they increased more, their margin is there. They're able to squeeze their margin to try to keep people from going from one lending institution to another. So right now you might see rates drop even though the Fed doesn't drop their rates, or also the Fed could increase rates and banks might not go up as much. But here's the second tier to this. So that was the two steps. But this is the second tier to this that I'm probably not the right person to explain it. So one of the things I really like doing as an instructor is I teach truck driving at a truck driving school. It's my daytime job. My nighttime job is teaching people how to make it to where you don't need a job. Is if you can't explain something simply, you don't understand it well enough to explain. So this might be something I don't understand enough to explain simply. So the problem is on me, not on you if you don't understand what I'm about to say. For the last 2 years, we've seen quantitative easing. The Fed prints money, $120 billion a month. The Fed is buying assets. They're picking up mortgages, the Fannie Freddie backed mortgages. The Fed has been buying them. So there wasn't a lot of risk because the Fed was generating money and they were buying assets. So the margin for lenders didn't have to be very large because the Fed was taking the risk, not the lenders. Well, now we're shifting, like the market is shifting. We went from a seller's market for 2 years and we're shifting to a buyer's market. Basically during this current housing crash, there are some things I'm doing differently, which I have videos covering. And yes, I'm calling this today, right now, a housing crash. And technically I'll explain why you've never actually seen a housing crash in your life, if you're my age or younger. But with quantitative tightening, what's happening going forward, we're less printing of money. The Fed's going to be buying less assets, which means more assets are going to be owned by the lenders, which is going to increase their risk. So they're going to probably be increasing margins. So there might even come a point in time when they are competing with each other and they have that narrow margin and the Fed doesn't raise rates, but banks may raise it to mitigate the risk of having to own more of those assets over time. So that explains why rates have come down 2 weeks in a row. Banks are competing with each other, even though they led the Fed and were just squeezing their margin to make those rates come down to try to keep you at the lending institutions that most other lenders, like credit unions and Guild and Fairway mortgage brokers, are setting their rates on. Here's why you've probably never seen a housing crash in your life. Why I haven't. Most of us talk about a housing crash, and I'm talking in a year. So peak to trough, we've probably seen a lot of housing crashes. But in 1 year, people talk about a housing crash and they say 20% or more drop in prices. That would be a housing crash. A correction would be 10%. And those are just kind of loose definitions that people use. The largest market-wide drop, entire country, because that's the thing. We don't have one housing market. We have almost 400 local markets that people invest in. So for the whole market, the largest drop in 1 year was during the 2008-2009 crash, where the entire market dropped 8.9%. So if the worst crash that most of us can remember in our entire life wasn't a 20% crash in a year for the whole market, we've never actually seen a housing crash for the market. We have seen local markets. For instance, if all the car manufacturers move away from one area, you're going to have that market tank. You have the dot-com crash, Silicon Valley is going to tank. You're going to have local markets that will definitely see crashes. But as people talk about an entire market crash, I've never seen one. And as a buy and hold investor, the last thing I'm going to wrap up with before I end this live, and then I'm going to do another live, I'll keep a separate video on the hidden costs of property management. And I try not to die going down the slides, which I probably will. I don't think I've gone down a slide sober in probably 20 years. That'll be fun. I hope this helped you understand why rates have been able to drop for the last 2 weeks while the Fed was talking about increasing rates. You are going to be alive in 5 years. You need to start investing like it, especially during a housing crash like we're seeing right now. This is the time I'm the most excited about taking action. Right now, I think is going to be one of the easiest times in my investing history to find a motivated seller. I didn't have the opportunity for the last 2 years to recognize a motivated seller because I'd see something listed on the MLS. By the time I even make a decision to buy it, it might be pending already. So how do you know if they were motivated or not? But now, what we're going to see with interest rates going up, sellers getting the fear of missing out, that fear of missing out shifting from buyers to sellers. Sellers are going to list at their wish price, numbers that don't make sense to buy at, whether you're going to live in it or looking for a yield as an investor. But the longer it sits on the market, this is the metric to watch, days on market. When you start seeing days on market increase more than it was in your area, so if you were seeing 60 days and now they're hitting 100, in my area, I was lucky to ever see 2 days on market. Now I'm seeing over 10. So you make an offer on the properties that are on the market longer than 10 or whatever the multiplier is in your local area, that is more than what it used to be. The not motivated sellers won't take your offer. The motivated sellers will. That's how easy it is going to be to find the motivated seller. There's 3 things you want to watch though while you're doing this. First, you need to track your area average rents almost daily. Check apartments.com, Craigslist, Facebook Marketplace, and see what is currently going on in your market with rents. In other words, you can't calculate your yield. Look at the prices, and yes, wish prices versus actual price versus the price that makes sense with your numbers to get the yield you're looking for. Or rates. And we can't watch what the Fed's doing. We have to watch what the lenders are doing. And you don't know what the lenders are doing unless you checked with your lender recently, like today or this week at least. And today being Thursday, I would have done it twice this week by now because rates changed often and loan products change often. And I happen to pick the day when they're doing all of the yard work here. So, can I go down the slide live? I don't know if I could do that. I will in my next live stream. I hope this has helped you. Until my next video, thank you for coming to my Dion Talk. Have a day full of marvelous.